Investing in growth stocks can be a great way to earn life-changing wealth in the stock market. The key, of course, is to know which growth stocks to buy and when. So, what stocks are growth investors interested in? Growth investors are constantly on the lookout for companies that reinvest their profits to scale out instead of paying dividends to shareholders. They're also interested in stocks in emerging markets and technology companies because they're usually priced higher than their earnings. To help you get started with growth investing, this episode will provide you with the strategies to position your portfolio for long-term success with growth stocks. What are growth stocks? Growth stocks are companies that increase their revenue and earnings faster than the average business in their industry or the market as a whole. Often a growth company has developed an innovative product or service that is gaining share in existing markets, entering new markets, or even creating entirely new industries. Businesses that can grow faster than average for long periods tend to be rewarded by the market, delivering handsome returns to shareholders in the process. And the faster they grow, the bigger the returns can be. Growth stocks tend to be more expensive than the average stocks in terms of metrics like price to price earnings, price to sales, and price to free cash flow ratios. Yet despite their premium price tags, the best growth stocks can still deliver fortune-creating returns to investors as they fulfill their awesome growth potential. Examples of growth companies include Facebook, Amazon, and Netflix. Is growth investing right for you? Most investors are often faced with this question. Listen, growth stocks are generally suitable for those that have a long-term prospect of reaping from their investment. So, if you're a retiree or you're close to retirement, growth stocks are not suitable for you due to time and volatility. However, you may still invest in growth stocks as a way of diversifying in your portfolio with a mix of bonds, international stocks, as well as dividend-paying stocks. If you're a young investor listening to this episode, growth stocks are suitable for you. And the reasons are not far-fetched. 1. You have a long time horizon compared to an investor nearing retirement. Secondly, you have more risk tolerance and are well positioned to benefit from growth stocks. However, keep in mind that your capital will be tied down for a long term, and there won't be quick profit. 7 traits of great growth stocks. As an investor, it makes sense to consider the value of putting money into growth stocks. After all, growth stocks are companies that are expected to outpace their peers in terms of earnings and stock performance. While these stocks don't usually pay out a dividend, the returns can be exponential. And as growth stock companies grow, they can even emerge into a dividend-paying company in the future. So, how do you identify great growth stocks? Historically, they're companies that demonstrate the following traits. 1. A large and expanding market opportunity. Nobody gets rich selling a niche product to a handful of customers. For any business to grow, they need a large and expanding market opportunity to hawk their wares to. For growth investors, the companies that are serving huge markets are the ones to go after. The bigger the pool of potential customers, the greater the chance of success there is. For example, consider Apple and the iPhone. Without a massive market, the iPhone wouldn't have seen so much continued success. Another example is Amazon, which started off selling books and later expanded to disrupt the entire retail business model. 2. A durable competitive advantage. Another trait you can use to identify great growth stocks is a durable competitive advantage. Warren Buffett, the greatest investor of our time, succeeded because he was always on the lookout for businesses with a durable competitive advantage. Growth companies usually demonstrate a significantly higher growth rate because they tend to possess a durable competitive advantage over other companies in the same industry. The competitive advantage gives growth companies a unique selling proposition, USP, which helps them sell and grow better than other companies within the same industry. It's also important to invest in growth companies that possess strong competitive advantages. Otherwise, their competitors may pass them by and their growth may not last long. Some competitive advantages are network effects. Facebook is a prime example here. Each person who joins its social media platform makes it more valuable to other members. Network effects can make it difficult for new entrants to displace the current market share leader, and Facebook's more than 2 billion users certainly make it unlikely that a new social media company will displace it. Scale advantages. Size can be another powerful advantage. Amazon is a great example here, as its massive global fulfillment network is something its smaller rivals will find extremely difficult to replicate. High switching costs. Switching costs are the expenses and difficulties involved in switching to a rival product or service. Shopify, which serves as an online retail operating system for more than 1 million businesses, is a great example of a business with high switching costs. Once a company begins to use Shopify as the core of its online operations, it's unlikely to go through the hassle of switching to another competitor. Low cost. A clear example is Costco Wholesale, a renowned and reputable producer. They can still make humongous profits even when they charge their customers less, thus giving them pricing flexibility over the competition. 3. Financial resilience. The next trait of identifying great growth stocks is the financial resilience of the company. Generally, growth companies can easily expand their business model with their internally generated revenue without recourse to the health of the financial market. However, they may not necessarily make so much profit the very moment they hit the market. Most growth companies reinvest their earnings to scale out their business operations, and they may also suffer short-term losses. 4. Repeat purchase business model. Growth companies understand that it's easier to sell their products or services to existing customers than attracting new customers to drive growth. A typical example of a growth company that drives growth through a repeat purchase business model is Starbucks. The company continually entices existing customers with daily hot beverages. On the other hand, GoPro, which produces long-lasting consumer electronics like cameras, have limited growth prospects because their products are durable and the chances of repeat purchase from existing customers are slim. 5. Strong past price appreciation. Great growth stocks are companies that have strong past price appreciation. Growth companies place great importance on their stock share price, which broadly reflects a corporation's overall financial health. As a rule, the higher stock price is, the rosier a company's prospects become. Wall Street evaluates the trajectory of stock prices in order to gauge a company's general health. They likewise rely on strong past price appreciation, earning histories, and price-to-earnings ratios, which signal whether a company's share price adequately reflects its earnings. All of this data aids analysts and investors in determining a company's long-term viability. 6. A great corporate culture. Growth companies should have a great corporate culture. A strong company culture attracts better talent and, more importantly, retains that talent. When people feel they belong to an organization, they're more likely to stick around for the long term. That means lower turnover, fewer new hires to deal with, and better chemistry among their team. A reputable review site like Glassdoor can clearly tell you if employees in an organization recommend their CEO or if they like the company's business processes. 7. Talented leadership with skin in the game. Because growth companies are focused on increasing the profits and sales of the organization, the management team is going to matter a lot. Growing a company requires an innovative leadership team. Without it, growth won't happen. Growth investors looking for their next investment will want to choose companies that have a leadership team with a good track record and a reputation for being innovative. Think of Jeff Bezos, Mark Zuckerberg, and Reed Hastings as innovative company founders. While it may not be easy to spot the next innovator, investors definitely should do some research on the leadership team before investing any money in the stock. The last thing anyone wants is to get stuck with a company that's following the pack instead of leading. Or possibly even worse, will be gone in 6 months to a year. While great leaders have been known to post short-lived successes, taking a look at a company's management team before making a growth investment can be an easy way to weed out some potentially high risks. Best growth stocks in 2020. Here are some of the best US growth stocks in 2020. Amazon.com, Facebook, Alphabet, Fiverr International, Slack Technologies, Microsoft, Activision Blizzard. That's it for this episode. If you found the information here useful, hit that like button. And if you want to support us even more, buy us a coffee from the link in the description. If you'd like to see more episodes on financial advice, hit that subscribe button and turn on the notifications for our latest updates. Good luck and see you in the next episode.